recording, I'm going to be working through the Finance Mock Exam Bulletin Express Pty Limited. And because this is the finance paper, as we are working through the information provided in the scenario, we are going to identify positive and negative factors. We are going to mark off all positive factors with a tick and all negative factors with a cross. Now, at this point, we don't yet know what the required looks like, so we don't want to go into more detail than that. For now, we are just looking for positive and negative factors. Then, when we get to the required, if we are asked to perform a SWOT analysis, then obviously the strengths and opportunities would be positive factors, and weaknesses and threats would be negative factors. So at that point, if we are actually asked to do that, we will then determine which of the positive factors are in the internal environment and which are in the external environment, or which of the negative factors are in the internal environment and which are in the external environment. Or if we get to the required and we are asked to discuss risks, then obviously all of the negative factors that we've identified over here will be risks. But at this point, we don't yet know what the required is going to ask, so we are just marking off positive and negative factors. Okay, let's work through the information provided in the scenario. Bulletin Express Pty Limited, or Bulletin, publishes, prints and distributes newspapers and magazines in Gauteng. The company was founded in 1980 by two businessmen, Andrew Green and Henry Moburn. The company's financial year end is 31 December. All right, so first we have a negative factor over here. We are dealing with a Pty Limited, or in other words, a private unlisted company. And this is going to be a negative factor because it is always more difficult for a private unlisted company to raise finance than it is for a listed company to raise finance. As internet costs continue to decline and accessibility improves, more people are using online media platforms, which poses a significant threat to the print media industry. This has led to a notable reduction in the circulation of newspapers and magazines. Revenue from advertising has also been negatively affected, as most advertisers shift their focus to online media platforms. The average operating profit margin for the industry is 5%. All right, so because of advancements in technology and the internet more specifically, more people are choosing to read newspaper articles and magazine articles online instead of buying printed newspapers and printed magazines. So this is obviously also a negative factor for Bulletin because they are operating in an industry that is declining. Driving diversity and inclusion is an integral part of the company's transformation and human resource strategies. A transformation committee was established during the current financial year. The committee is responsible for identifying initiatives and monitoring progress towards achieving the company's transformation targets. All right, so this is obviously positive from a social perspective because it will help with transformation. Andrew Green, one of the founders and current Chief Executive Officer of Bulletin, plans to retire at the end of the year. He currently holds 5% of the shares in Bulletin, which he wants to sell so that he can purchase a house in Mauritius and spend his retirement on the beach. He valued the total company at 59,377,500 Rand, using Bulletin's current year profit and the price earnings multiple of a similar listed company. The similar listed company has a national footprint and specializes in print and online media, packaging, and label printing. Okay, so we have another negative factor over here because Andrew Green is one of the founders and the current Chief Executive Officer of Bulletin. So if Andrew retires at the end of the year, the company is going to experience a loss of expertise. After an unexpected increase in employee workplace injuries, management introduced biannual health and safety training, which is mandatory for all employees. The production manager also inspects the plant on a weekly basis to identify hazards. All right, so the fact that there was an unexpected increase in employee workplace injuries is obviously a negative factor. However, management is trying to address that negative factor by introducing biannual health and safety training, which is mandatory for all employees, and also the production manager is inspecting the plant on a weekly basis to identify hazards. So the fact that they are trying to address this problem is obviously positive. Then next, we have an extract from the statement of profit or loss and other comprehensive income. Now guys, you'll remember just above, you were told that Andrew Green valued the total company using Bulletin's current year profit. So this amount over here that he is using in the calculation is the current year profit. Let's go through the notes on the next page. First, in note 1, we are given more information relating to revenue. The state of the economy worsened over the second half of the current year, and this severely impacted demand. Competitor activity intensified as a result of the decline in demand. So they are dealing with tough economic conditions, which is obviously a negative factor. And in addition to that, there's been an increase in competition, which is obviously also a negative factor. Then in note 2, we are given more information relating to raw materials used. All paper is imported from the USA and ethically sourced from environmentally responsible forestry companies. Okay, so if all paper is imported from the USA, that is going to expose Bulletin to currency risk, so that is a negative factor, because if the rand deteriorates against the US dollar, that will obviously have negative financial implications for the company. However, the fact that the paper is ethically sourced is obviously positive from an environmental perspective. Then in note 3, we are given more information relating to other operating costs. Other operating costs include directors' remuneration of 10 million rand in 20X6 and 8.5 million rand in 20X5. Due to the deterioration in performance, the directors agreed to salaries which are 20% less than market-related salaries in both years. Then in note 4, we have information relating to dividend income. Bulletin holds 100,000 shares in Stationery Suppliers Limited. Dividends are expected to grow by 12% for the next 2 years and then by 10% indefinitely. The shareholders' required rate of return is 15%. We then have some non-financial performance indicators. So for both years, you've been given the number of employees, the number of employee injuries, the percentage of black employees, the BEE rating, the electricity usage in kilowatt hours, water usage in kiloliters, and greenhouse gas emissions in tons. Bulletin is committed to protecting and conserving the natural resources on which the business depends. Energy metering and control systems have been installed to facilitate energy reduction measures. The introduction of water metering to control consumption and identify leakage is in progress. All right, so both of these things here are obviously positive factors from an environmental perspective because it should result in a reduction of electricity and water usage. Future initiatives. First, we have the investment in an online media platform. The company is investigating the development of an online media platform to hedge against the decline in print media. All right, so we already saw on the first page that there has been a decline in print media because of advances in technology and because of the fact that the internet is more easily accessible and the internet costs continue to reduce. So more people are choosing to rather read news articles and magazine articles online instead of buying the printed copies. So they are now looking at developing their own online media platform to hedge against the decline in print media. The majority of revenue will be earned from advertising. Customers who want to read articles without advertising will be required to create an account and will be charged a monthly subscription. A feasibility study has been performed to determine the expected revenue that will be earned from advertising and monthly subscriptions. Fees have been calculated using existing selling prices and adjusting for savings in paper, printing, and distribution costs. Quotes have been obtained for hardware, software development, and graphic design. Annual operating costs have been estimated and include salaries of IT personnel that will be appointed to deal with any unexpected problems and perform ongoing maintenance on the platform, depreciation of hardware and amortization of development costs which qualify to be recognized as an asset in terms of IAS 38. Management wants to assess the investment over an initial period of 5 years using the net present value method. Then the second future initiative is a carbon reduction project. A carbon reduction consultancy firm will be appointed in the upcoming financial year. The consultancy firm will provide guidance on how greenhouse gas emissions can be reduced and climate change goals achieved through the deployment of climate-smart energy projects that strike the right balance between sustainability and cost. All right, so this is positive from an environmental perspective because it should help reduce greenhouse gas emissions. Financing of future initiatives. The following finance options have been identified. Option 1 is a loan from their commercial bank. Obtain a loan of 5 million rand from their commercial bank. 2% transaction costs will be payable immediately. The interest rate on the loan is 1% above the prime lending rate. Interest and capital is repayable in 4 equal annual installments with a final balloon payment of 1 million rand at the end of 4 years. The loan qualifies as an instrument and is deductible for tax purposes in terms of Section 24J of the Income Tax Act. A significant portion of assets will be pledged as security for the loan, and debt to EBITDA must not exceed 0.5 for the full duration of the loan. All right, so if they go for this option, they're going to have a significant portion of assets that have to be given as security for the loan, and in addition to that, they have debt covenants that need to be complied with. So debt covenants are just restrictions that the bank will impose on the company to protect themselves against bad debts. So in the event that these debt covenants are not complied with, then the full loan becomes repayable. And if Bulletin doesn't have the money available to repay the full loan, assets have been pledged as security for the loan, so the bank will then repossess those assets to cover their loss. Then the second financing option is non-redeemable preference shares. Issue 50,000 non-redeemable preference shares with a nominal value of 100 Rand each. These preference shares carry a cumulative dividend that is payable annually at 8% of the nominal value. Then finally, we have some additional information. The prime lending rate is 8%. The corporate tax rate is 28%. And Bulletin paid dividends of 2,639,000 Rand in 20X6 and 3,338,000 Rand in 20X5. All right, so that's all of the information that we've been provided with in the scenario.